Hello, welcome to this new edition of the video market analysis. This is Ashraf Laidi, and happy belated Christmas, and I hope you had a good break. And those of you who are still in a break into the New Year's Eve, hope you're enjoying it. Just a slightly shorter than usual video here regarding that historic day that happened yesterday. Why is it historic? Because it was the biggest point gain in the Dow. 1,086 points, not the biggest percentage change, but it was a very big percentage change, 5% on the Dow and on the S&P. And after two attempts of buying the Dow, failed attempt, we finally went in on Wednesday, yesterday morning, and we got successful. Some may say we got lucky. We got successful and we made 600 points. Even 600 points was not enough to capture everything, but I did lay out the reasons, and we always try to give reasons. And the reasons was that the head and shoulder, the multi-month head and shoulder target in the DAX was achieved. The other reason was that in the S&P, not in the DAX, but in the S&P, the Monday low was 200 week moving average, and it was also a 20%. Okay, and we wrote that in the IMT before. There were some other things, like for instance the Canadian yen here, where the left shoulder here matches the right shoulder, and this right shoulder, and then this right shoulder, this will also match the low. And this is the euro and silver. I'll talk about this separately, but here is what I think as far as today's price action. For those who are trying to go into more buying, I do think that there is probably a slight chance that we will push higher. Just bear in mind, right now the Dow is at 22,450 here, 22,450, and if it goes to 25,000, we will be even for the year. We won't be down for the year, and that means is around 1,600 points, and that also means probably another 9% or 8% from here. And so, sorry, it would be 2,700 points, 2,700 points, and it's possible because, well, there is there's Thursday today, there's Friday, and then there's Monday. There is 3 trading days of the year left, and it's possible. But instead of just talking about these things, let's just so basically, let's just talk about the details here of the Dow. If you look at this, you'll basically see that this candle, and the same goes for the S&P. So you had, what was interesting is that yesterday's candle was twice as much as the previous one, and today one of the basics of bar analysis, of candlestick analysis, is that if we hold above halfway this, so if we hold above 50% retracement of yesterday's candle, and also above the open, or the open of the prior days, and that would be a positive sign for indices. It could be a positive sign. So this means as long as we don't close below 22,290. Okay, so that's important. And just for those of you who have seen, I've spoken a lot about the February 2016 low, which was this low here, the famous low of the last big decline. And February 2016, look what we had. We had a similar rally, not as much as if you want to go here. It was February 12th. It was 2%. It was not 5%. So it was 2%. It was still big. But here's what happened after that rally, after we reached the bottom. After that rally, we had not only a gap up, but we also had another rally and another rally, and in 3 days we went into, we regained that sub move. So we're not seeing this today. Now, just a slight word on fundamentals. What we need to know here is that what happened, what was the reason, and the reasons, I mentioned them. I did mention them here. We basically said So the reasons was that the S&P 500, the low, it coincided with the 200-week moving average and the 20%, and there were also the dollar yen was a nice bottom, and we did take profit in there, and also on a fundamental reason is that Treasury Secretary Mnuchin said he was going to hold a meeting with the plunge protection group, and so he was going to make sure there's going to be liquidity and so on and so forth. So from all senses, it was what you call the perfect storm. Okay, and what I'm talking about here is that if you look here, if you see this chart, you will see that well, thank you, computer. So if you go here on the monthly, you will see that that bottom respected the 2009 trend line support, a very important low here, and it respected the 200-week moving average. And this is what I mentioned, this is not just backward analysis or hindsight. And also this move corresponds to a 20%. Not the same for the Dow, but for the DAX, and because the not the same for the Dow, but for the S&P 500. But and the S&P 500 is the more widely followed by hedge funds and mutual funds and so on and so forth. So this was what you call the perfect storm, and we had a nice bottom. This was a good excuse, probably more than any other excuse or explanation for us to get back in. All right, so this is and if you want to go in the Dow, it's not the same. And I mentioned this in the IMT, which goes for free, which is called bear mathematics. And the 200-week moving average is still below, but this low still signaled the 200, signaled a 20% decline. And what I talked about the Canadian yen here is that also the Canadian yen, so it's basically, it's a very big trade reflecting risk off, risk on. Because right now oil is a big move. It moves wildly higher when stocks goes up, wildly lower when stocks go down. So the Canadian reflects that, and the yen is the anti-market. So, and what we had, the decline was more than enough. So we stabilized here. So this is important. But let's just talk about here basically. So how to make money here is that if for those of you who are really trying to get back in stocks and trying to see whether it's a good, if you want to buy, make sure that we don't go in the S&P below 22,000, in the Dow, make sure you don't go down below 22,300 to 22,200. As long as you don't go down, there's a few chance for you to make around 3 to 4%. Silver. And this was a big rally here, and this is very good news for gold, because when silver goes up, usually it leads gold. So we've broken below this trend line, very important level, and it looks like the next level is probably going to be 1540, which is a 200-day moving average. But what does this mean for gold? Because a lot of you don't like to trade silver because it's expensive, it requires more margin. But here's the thing about gold. So I was saying 11, so we did hit a target. I was saying 1266 the whole time. I was saying 1266, 1266, and we've broken above 1266. Now we're at 1275. So 1266 basically it was the head and shoulder target, the distance between here and here. But here's what I think the way we can look at this. I think that if you look, instead of using the falling neckline or trend line, and if you just use this, if you use this distance here and you say, well, if you take the distance from this high, if you don't do it on a declining trend line, but if you say the high, the difference between 1200 and 40, okay, so around 1240 or 1245, if you want to talk about this high, because this is how you basically measure the targets for flags, bull flags, or triangles, from the highest point to the lowest point. And if you overlay this higher, the difference between 1200 or 1196 and 1242, it will give you around what? 40. Add 40 or 42 to 1242 and you get around 1285 or 1290. So we're probably talking about, we have just a little bit more to go to 1290. So that is a possible viable point, which is just around this level here. So basically this is what we're talking about here. Regarding the euro, we're still respecting the trend line, and I still say that we're still gonna have to go to 1477. We have to negotiate with 1447, a level that hit and failed a few times. There's a lot of funny action going on towards the end of the year, what you call demand for dollar liquidity and so on and so forth. So there might be some short-term spurts in the US dollar, but this is basically the story. And this is one which we missed on. We did not get back on it. We failed on dollar Swiss, and it's really 98.90. Now it's pushing higher, but it's really testing 98.40s, 98.30. So this is something we're gonna keep pay attention. From the grand scheme of things, ladies and gentlemen, is that a Treasury Secretary meeting with the regulators and everything is not enough for us to go back to an all-time high, to a new high. The main reason, the main way for the stock market to continue to push higher is if or when the members of the Federal Reserve, they go on board with the expectations of the Fed funds futures and the Eurodollar futures, meaning the dot plot of the human beings at the Federal Reserve will start to agree with the Fed funds futures and will basically no longer expect two rate hikes for next year. Once you will see the communications of that, right now it's a break, but when they start talking, the next FOMC is in March, but I think they're going to start talking from mid-January to late January. It's going to come from the testimony of Powell. I think it's going to be in February. This is very important. Mid-February is a very important testimony by Powell to a joint Congress, and if he's going to stick to the line that we're going to expect one or rate hike or two, then we could see stocks fall further down and the dollar probably to stabilize. If he's going to toe in the line of the market, then that will be the next big leg for the market higher. Thank you very much. All the best, and we may be looking for probably potentially issuing a long Dow if we do drop towards that support. And then I also have for you some important chart and statistics for this year and next year. We're gonna release it for the premium subscribers. Thank you and all the best. And I'll probably have a video, probably one before the New Year's. So we'll catch you for one more video for the year. All the best. Thank you.